Hey traders, welcome to the Top Tier Outlook. Great to see everybody. Hope everyone's having a good weekend. I hope it's been peaceful and productive. And I got to see quite a few of you at our Simpler Summit over the weekend. We had our day-long summit in Orlando, so that was great. Glad to be back in South Florida. So again, if you made it out there, awesome. It's good to put some faces to the names. And we're going to take a look at what's going on in the markets as we start off our Sunday trading. One of the things that I was writing about in the Top Tier Outlook, the newsletter that'll go live tomorrow for the newsletter subscribers, as well as my Sector Secrets Mastery folks. One of the things I was kicking the newsletter off with is a simple statement of, it's never the markets, right? What I mean by that, it's never the markets, even though that's very common vernacular for us as traders. What does that mean? The markets? Does it mean all stocks? Does it mean all indices? Does it mean currencies, energies? These don't all move together. Currencies don't have to move with treasuries. Treasuries don't have to move with energies. Energies don't have to move with currencies, and equities don't have to move all together, right? Certain sectors can outperform. We have some indices that are in downtrends, right? We have some indices that are still in chop. So it's a tough habit to break, but it's yet one that we can all do, which is not to think in the market. Now, I realize when most people say the market, they're usually talking about the S&P 500. And one of the things that I did during the Simpler Summit over the week, this Saturday, is during my talk, I said, look, if we're going to look at equities, we have to look at its role in a sector and the sector's role in the index. Now, that would be from the bottom up, stock, sector, index. The way I like to look at it is top down. If I look at top down in the Dow, right, the Dow is probably, of the big three indices, S&P, NASDAQ, Dow, the Dow is probably the most bearish. And when we think about, well, why is the Dow the most bearish? And how come the NASDAQ isn't punching down to lower lows? And if you want to broaden that out to include the Russell, how come the Russell's had new lows for the year, right? You take a look at weakness. Here's the Russell. Here's new lows for the year. How come the NASDAQ isn't looking at new lows for the year? How come the S&P is not looking for the new lows of the year? Because markets, in meaning the markets, don't have to all move together. The sectors, the indices, they all have an impact on each other. So what do I mean? Well, let's take a look at the S&P, for example, which has started to grudgingly embrace a downtrend. The reason for this is really simple. The S&P can track with the Dow. And the Dow is mostly financials, tech, and healthcare. The S&P is tech first, then financials, then healthcare. Now, why does that order matter? If the same sectors are weighted in the Dow more or less than the S&P, how come they're not moving in more lockstep? It's the order or the weighting of the high concentration weighted sectors. Well, let's take XLK for a moment. XLK is not in a downtrend. It's pulled back. And this is the pullback that we've had this month, even starting in September from the July or even the August highs. Tech is actually hanging in there. It's still above the 200 exponential moving average, and it's choppy. Now let's take a look at financials. Financials are heavily weighted in both the Dow and the S&P. Financials look very different, don't they? They've been testing and they've been really quite convincingly below the 200 exponential since the beginning of the year. Beginning of the month, and they broke this level at the end of September. So this is why I can't say the markets, right? We have a lot of tech names that are doing all right. We have some tech names that are not that strong. So again, one of the dangers in the markets, Tesla looks markedly different than, say, Meta, right? These are both tech names, right? Tesla looks markedly different than Meta. Meta is stronger, right? Tesla is actually in a downtrend. So if I were to look at all tech names and I single this one out as well, we could buy Tesla. No, right? The relative outperformers are actually Microsoft and Meta. And we only know relative outperformers when we compare things that have something important in common. And this does not mean technical importance. This means what is the stocks weighting in the sectors and the indices in which stocks tend to move together, right? So if you're really starting to think about what's happening in the broader averages, we can't paint everything with one brush, right? And clearly October's been tough. And up until recently, the only time we had a significant amount of weakness in tech was probably here in July, right? From July to August. And we just started to go choppy really ever since. I wouldn't call this a significant breakdown. I wouldn't even call it that bearish, because if we want to separate bullish territory from bearish territory, that 200 exponential is really going to be it. So this would be the lowest we've seen a pullback. And then this is where, for those of you that want to take the high of the year, look at a 10%, 20% pullback. We could talk about those corrections, right? But don't get trapped into thinking that a correction is then viable, right? The Dow is corrected quite a bit. So the danger is in thinking that a stock or sector or index below its 200 should be on a buy watch list. I generally will not put a downtrend on any kind of buy watch list, because the probability is not for stabilizing and therefore higher highs. It's really most probably going to see lower lows, case in point, the Russell, right? Why is the Russell heading lower? Regional banks. Regional banks are heavily weighted in the Russell, right? Do you think the NASDAQ gives absolutely a rip about regional banks? It does not. It actually doesn't even care that much about big banks. It cares about Apple, Microsoft. It cares about Meta, Google. It cares about Amazon, Tesla. It cares about NVIDIA. Magnificent Seven. Why are they so magnificent? I don't know if they're all magnificent, but they're magnificently weighted. Their influence on the NASDAQ is really without peer. And so therefore, what we remember is that if a small number of high concentration weighted stocks are moving, that is what's happening at the index level. So this is why we don't want to talk about the markets, right? Because the Russell's doing something very different than the NASDAQ, and regional banks are doing something very different than, say, semiconductors or communications, right? So choppy markets have a certain mannerisms, downtrends have a certain mannerism, and it is our job to categorize each symbol into whichever behavior it's exhibiting. Now, not what we wish we had, not what it did a year ago, not what it did 6 months ago, really not even what it did in August or September. October has been its own month. Another thing I'm going to talk about in the outlook is, what do mutual funds have to do with some of what we've seen in October? There is a phenomena every October that has to do with mutual funds, and it is not normally this volatile. But I'll walk through one of the things that probably has a little bit more impact this October because of certain types of funds being down year to date and the year end of some mutual funds. So I'll get into that as well. And that's all in the top tier outlook. But suffice to say, October has been heavy, and we might be able to point to a little bit of tax loss harvesting in mutual funds, equity funds, in bond funds, actually, interestingly enough. All right. So that's what I've got to sort of kick off the show. So let's go ahead and jump on into the questions. If you have a question, feel free to ask. And we're going to take a look at the daily time frame here, the larger chart on the right. And we've got the 5-minute just to take a look at the open, the Asian session open on that thin chart on the left. All right, so let's get to it. First question, Nick, what's my favorite costume for Halloween? I'm going to tell y'all something, and it might be a little upsetting because some people love Halloween. I actually do not like Halloween, not even a little bit. Never really have. So I don't have a favorite costume. I will say, when it's dusk and the little ones come out, like the little ones, they're pretty darn adorable, but they could dress up as a marshmallow. It doesn't matter. They're pretty adorable. But yeah, I actually do not like Halloween. Even as a kid, I did not like Halloween. So I don't have a favorite costume. Rocky, you don't like Halloween? I really don't like Halloween. All right, next up in that question, what do I think of the Euro US? I think of the Euro US the same thing I think about the 6E. and that is the euro continues to lose ground against the US dollar. The euro went neutral last week, which is a pretty big deal. We haven't seen a neutral structure, a neutral market trend in the euro since end of July and into beginning of September. And ultimately, what we have here is a neutral environment below the 200. This means that we have a neutral environment in the dollar above the 200. And if we're going to see a shift, this would be as good a time as any to see it. I can't yet really buy the euro. And if I do, by the way, can I buy a neutral yellow structure, neutral yellow trend below the 200? I can, but I just have to acknowledge the 200 amongst probably other levels is going to be an obstacle to the upside. And what I'd like to do here is take advantage of either the daily price movement range zones. You can see the gray zones here, or this Darvis level at about 105, 104.81, about the 105 handle. So I would like to buy it. I would like to buy it, but the path of least resistance is still to the short side. So if I end up at the oversold level of this chop, I'll buy it. If I end up at the overbought level of this chop, we could short it and just play them for short-term swings. All right. Next up, I love the enthusiasm. Yeah, let's get to Monday. Let's get to next week. Yeah, I love the enthusiasm. That's awesome. Yeah, Yee, I'm with you. We've got the FOMC on Wednesday. We're going to hear about how potentially dovish they are. Are they going to commit to there will be no more rate hikes this year? I think they've tried to commit as much as they can without pigeonholing themselves, without, as I say, painting themselves into a corner. But we do have a lot of hot zones this week. We've got non-farm payroll. We've got ISMs. We've got, I'm taking a look right now, ADP, JOLTS, FOMC. JOLTS and FOMC are all on Wednesday. So ADP on Wednesday, JOLTS on Wednesday, FOMC on Wednesday. We have Bank of England, which could be interesting. Non-farm payroll on Friday. We have a lot going on this week. The only reprieve from high-impact schedule events, data releases, is Monday. We don't have any major hot zones on Monday, but I'm with you, lots of big-time hot zones coming up this week. You bet. All right, John asks, is it possible to trade the day on the SPX from one side of the daily price movement range to the other? Yeah, for sure. So one of the things I mentioned during the summit is a lot of folks want to know about how to trade the SPX. And I try to tell folks it's not about how to trade the SPX strategically any differently than how we would just discuss how to trade the SPY or the ES futures or the MES micro for that matter. The difference is what is the strategy and what time is a strategy. So that one of the advantages of the S&P futures is the liquidity that's nearly 23 hours a day. I have 23-hour access to the S&P, and most of those hours are pretty darn liquid. There's going to be sufficient open interest. There's going to be sufficient volume. So I can see what's happening in terms of Asia's opinion of the S&P 500, Europe's, UK, and then on to the US. All right. So then we move on to the SPY. Now, the SPY is a 9:30 to 4 o'clock conversation, something that I will trade for the most part with options, calls, and puts on SPY. I'll buy calls or I'll buy puts, and SPY will be an ETF alternative to the ES futures. All right, so then where does the SPX fit in? SPX is going to go where the S&P goes. So the first question I get is more related to chicken or egg. What's going to move first, SPX or the S&P futures? Let's not think of it that way, because what that does is cause there to be this rabbit hole of what leads what. I'm going to say this as blanketly as I can. Nothing leads anything. I don't believe in leading indicators. They don't exist. If it needs price, it can lead price, right? I don't believe in leading symbols, right? Will oil stocks roughly go where oil goes? Yes, but we've seen pockets of extended periods of time actually where oil stocks can do one thing and oil can do another. So the more we can let go of this need to believe that some things lead something else, the better off we'll be. The reason I bring that up is inevitably people will ask, well, who moves who? SPY or SPX, ES? Let that go and ask yourself, what am I needing? Do I need the more 23-hour approach? Am I comfortable with futures? Or am I going to perhaps write premium, which is going to be far better to do in the SPX, right? There's certain things that the SPX will be better doing. There's higher implied volatility in the SPX. There's more options liquidity in the SPX. And therefore, if you're wanting to take advantage of that higher liquidity, then choose that version of the S&P. So rather than trying to find out which one's the best, which one leads this or that, which I know is not your question, but it inevitably goes there, just trade the symbol for what it is. Now, the real question you asked here, John, let's get to that. Can you trade the daily price movement ranges? Absolutely. Yes. Can you go DPMR to DPMR? Here's what I tell you to do, John. Pull up the DPMRs, step 1. Go to the 1-hour chart, step 2. And then do all the kind of strategies that I teach. What can I do in a red trend? Which zone do I focus on? How do I want to confirm that? Where is my maybe level I want to move to a break even or even an optional target? What's my target? I'm just going to go right back to the same thing that I would do in a 1-hour chart of Apple, right? So I'll go right back to the strategies, but I would say go with a 1-hour time frame. And can you go DPMR to DPMR? Absolutely. Absolutely. I don't see any issue with that. But having said that, John, you could do the same thing with the ES. We could do the same thing with the SPY. Again, ask myself, do I want to go DPMR to DPMR outside of the 9:30 to 4 hours? Do I want to go DPMR to DPMR and emphasize on higher implied volatility and therefore be a writer or a seller, right, of option premium? That's gonna one example, more hours, accessible, S&P futures. Higher implied volatility favoring those of us that want to collect credit. SPX, you want something more sedate, lower cost to go from DPMR to DPMR, SPY. And that's the way that I look at that, John. What do I need, right? Rather than trying to pick out the best one or the one that leads another, what is it that I need the symbol to accomplish for me? And that's where the choice will happen. So I hope that makes sense. Thanks for the question. Call want asks, can I explain the effect of correlation, TLT, DXY, gold, and TNX in the stock market? So basically, call want, for those of you that are unfamiliar, it's long bonds, dollar index, gold, and the yield. Well, the yield is on the 10-year, whether you're looking at ZN or IEF, right? Or if you're looking at TLT or ZB, those are all just different ways of looking at treasury yields. So TLT, ZB, TNX, ZN, IEF, that's all 30 and 10-year conversation. We know why they move for the most part together. There's either higher or lower yields, and those symbols move in tandem. So what do yields have to do with, say, currencies like the US dollar? Little to nothing. What affects the dollar also affects Treasury. So rather than drawing a line, think of it more as a fork, right? As a division. Monetary policy affects yields. Monetary policy affects US dollar, right? But then there are things that affect bond yields that don't necessarily affect the US dollar. Gold. There are things that affect gold that don't necessarily affect the US dollar or yields. Generally speaking, gold is a play on real yields, which is the nominal yield of a bond minus the rate of inflation. But gold, more so than the other two, even more so than the dollar, will respond to geopolitical stress. In any time of geopolitical stress, gold is typically going to be pretty strong, and it will shed its real yield relationship and just move according to, whatever issue is happening somewhere in the world. So that's definitely something that I'll look at, but I will never say a correlation is the justification for a trade. Some traders might ask, Rog, is the XLF DIA or the regional banks and the Russells at a correlation? No, not at all. What it is weighting, right? If I know what's inside those stocks and that group within the larger group is moving and has a lot of influence, then I know there's likely to be a nice synergy, right? So it's really a causation that we're looking for. And the causation is monetary policy. With all three of those, with the exception being during geopolitical stress, gold can do its own thing. So that's the way I look at that, Kalwan. And that's just the way that I look at that, right? That's the way that I look at that. All right. Let's see. What else do we have here? Um, yeah. So not liking Halloween is not liking fundamental and technical analysis. I just don't like. I mean, there's a lot of cool holidays out there. I guess the kids like it, right? Who doesn't like candy? I suppose. Although I will tell you this, candy now, I still love an almond joy. Why do they taste so different now? Almond joys now do not taste like the almond joys of my youth. I don't know what that is. And the candies of my youth I loved, like Zag Nuts. Remember those? They don't exist. So I'm very disenchanted with candy. All right. Next up is, yeah, my pleasure. My pleasure. And this is a great question to wrap up the show. Ranbir asks, I'm new to this. Is it a legit career if I start educating myself? I will tell you this. Is it something you can do? You know, I just finished telling a group of people that if you're willing to educate yourself, you have risk capital and a little bit of luck. I will say a little bit of luck in trading is really helpful. Um, Career, I don't want to say, I don't want to make that leap, right? Can you do this successfully to some degree? Yes, right. Absolutely. Is it something that everyone can do? I will tell you, a little bit of luck is the one thing that nobody wants to talk about. If we start trading in 2020, which was a very easy year to trade, you can grow a small amount of money very quickly and you end up with a cushion. The problem is those folks who grew the accounts in 2020 likely blew up in 2021 because it didn't teach them anything. So you hit the nail on the head, Ranbir, which is if you start educating yourself. But anything where we have the risk of uncertainty, we are only playing probabilities. I wouldn't start off with career. Can someone start off and say, this is what I'm going to do for a living? I would never tell anyone to abandon everything else and just trade for a living. I think it helps in the early stage to have trading contribute to your overall income rather than it be your overall income. I will tell you that helps a lot. So whatever current career you have, whatever job you have, however you're paying the bills now, you could do less of it to free some time up for trading, but I would never just say abandon everything and start trading. Presume that you are not going to make a dime for 3 to 6 months, maybe a year, right? How many people can do something without making a reasonable amount of income for a year? That's what I would presume, which is why I say do not just say I'm all in on trading. I'm going to just be a trader and that's how I'm going to pay my bills. Don't do that to yourself. This is a very challenging career. And it can be something that's going to be a career, Ranbir, but first start it off, not as a hobby, but as a part-time thing. Find a strategy, find a time frame that you can dedicate maybe an hour a day to, right? Or a half hour, it just depends. And start there. See if you can build a track record, demo trade, paper trade. See if your strategy actually does have a high probability of working. The wonderful thing about starting now is you're going to learn a lot. You're going to learn how to trade in a difficult environment. The awful thing about starting now is it's a difficult environment. But I think traders who learn how to trade in 2023 are miles better off than traders who learned how to trade in 2020. Nobody learned anything in 2020, right? Because what happens is when we make money, we think we're geniuses. We confuse a bull market with brains, as one of my mentors used to say. And we don't ever stop to say, how do I optimize this? Am I just getting lucky? Where are my stop losses? Am I position sizing too large? So those are all things to think about. It can be done, Ranbir, but I don't want to in any way suggest that the current environment is going to be really kind, because it won't be. But you will learn a lot more now than if you started in 2020. All right. So there's both pros and cons to that. All right. Be good to each other, gang. I'll be back for Charts and Coffee tomorrow. If you want to know how I'm trading, what I'm doing, if you want to get alerts as to the kind of trades I see as being both risk, places we can control risk and high probability, come check out what we're doing in the Sector Secrets Mastery. You can check it out at sectorsecrets.com. All right, gang. I'll see you all tomorrow. Be good to each other.